Hey, and welcome back to Charged Alpha. I'm Hudson Thomas, and if you want to know what happens when the world's most dominant aircraft engine maker spins off from a sprawling industrial giant and suddenly finds itself with a $190 billion backlog, well, that's exactly where we are with GE Aerospace today.
I'm Lana Chen. And that backlog isn't just a headline number, Hudson. It's literally all the work this company's committed to do over the next several years.
Right, so today we're doing a deep dive into GE, ticker GE, and understanding why Wall Street's excited, what could go sideways, and whether the valuation actually makes sense right now.
So let's start with the basics. GE Aerospace is the world's leading pure-play aerospace propulsion company, and they're headquartered in Boston.
The key word there is pure play. Up until April 2024, this was buried inside a massive, sprawling General Electric. Now it's standalone, 57,000 employees, and they're doing one thing really, really well, making aircraft engines and the components that go with them.
They've got two operating segments. Commercial Engines and Services, or CES, handles the CFM LEAP engine, which powers about 75% of the world's narrow-body aircraft. Think every Boeing 737 MAX and Airbus A320neo you've ever seen.
Then there's Defense and Propulsion Technologies, DPT, which serves the military side. And here's the beautiful part. Roughly 70% of GE's revenue comes from high-margin aftermarket services, all that maintenance and repair work that keeps engines flying.
They've got about 49,000 commercial engines in service, plus another 26,000 military engines. When those engines need maintenance, GE's the one getting the call.
And they're entering a really interesting inflection point. The LEAP fleet, which entered service around 2016, is now hitting its first major maintenance cycle in 2026 and 2027.
That's called a borescope inspection, engine removal, full shop visit, the whole deal. And analysts expect that to drive anywhere from 30 to 40% more shop visits than we've seen historically.
So we're looking at a company that's not just riding the back of high production volumes, it's about to ride a second wave of recurring service revenue. The CEO's Larry Culp, and his story is pretty interesting. He's been running this company for 8 years now, but here's the thing. He was the first outsider to ever lead General Electric in 126 years.
Before that, he spent 25 years at Danaher Corporation, where he was CEO from 2001 to 2014. And in that role, he quintupled the company's revenues and market cap while building out their famous playbook of acquisitions and operational excellence.
When he came to GE, the company was in rough shape. He's reduced debt by over $100 billion, doubled EPS, and quadrupled market cap, all while preparing the aerospace spin-off.
Wall Street views him as a disciplined operator, very focused on cash generation and capital allocation. Not flashy, not a showman, but someone who delivers on operational metrics.
All right, let's talk valuation and fundamentals. Stock's trading at $288.60 right now, which puts the market cap at about $297 billion.
The PE ratio is 34.55 on a trailing basis, but the forward PE is 44.1. That's a pretty wide gap, and it tells you the market's expecting significant earnings growth ahead.
How significant?
Management guided to 7 to 7.40 cents in adjusted EPS for 2026, which is 14% to 15% growth, and that's coming off a trailing EPS of 6.37. So the forward PE is consistent with that growth expectation.
What about the top line? They posted $12.7 billion in revenue last quarter. That was Q4 2025.
Last year was wild for growth, 21% revenue increase in 2025. This year, they're guiding to low double-digit growth, so maybe 10% to 12%, which is more sustainable.
And operating margins?
Here's where it gets interesting. They're running a 20.68% operating margin right now, with gross margins at 37.7%. Those are really strong numbers for an industrial company.
Are those margins sustainable, or is that riding on a wave that's about to crest?
Part of it's the favorable mix shift toward aftermarket services, which have higher margins than engine production. But they're also facing supply chain headwinds. Raw material costs are up more than 40% year over year.
So there's margin expansion potential as they hit that MRO surge, but also margin compression risk if commodity prices stay elevated.
Exactly. On the cash flow side, they've got $7.7 billion in trailing free cash flow, which is just enormous. Operating cash flow is $8.5 billion, so they're converting earnings to actual cash at a really healthy rate.
What's their balance sheet look like?
Cash position of about $12.4 billion, total debt of $20.5 billion, so net debt of $8.1 billion. Given the FCFCF generation, that's a manageable debt load.
Is that debt going to increase, or are they paying it down?
Management's focused on deleveraging and returning cash to shareholders. With $7.7 billion in annual FCF, there's plenty of room to pay down debt, fund dividends, and do share buybacks.
So the financial picture is one of a company generating serious cash, expanding margins in the near term, but facing valuation questions.
Right? A 44x forward PE is not cheap. For context, the S&P 500 is trading around 22x forward, so you're paying a significant premium here.
What justifies that premium?
The backlog, the installed base, the margin expansion, and the fact that aftermarket services are essentially recurring revenue. The LEAP fleet isn't going anywhere for 20 to 30 years.
So you're betting on that MRO cycle, that backlog conversion, and disciplined capital allocation. Overall, GE Aerospace's financial health is solid. The company has fortress-like balance sheet metrics, exceptional free cash flow generation of $7.7 billion annually, and a $190 billion order backlog providing multi-year earnings visibility. What's the analyst consensus look like?
Buy across the board. Out of 20 analysts covering the stock, 18 are buy, 2 are hold, and 1 is sell.
And the price target?
Average is $355.65, with a range from $290 on the low end to $425 on the high. That $290 target is actually right around where the stock is trading now, so there's already a dissenting voice saying valuation is stretched.
What's the upside implied by that consensus target?
About 25% from current levels, so the street's telling you there's meaningful room to run if execution stays on track.
Let's talk about some of the notable calls. Any standouts?
Daiwa Capital Markets is one of the skeptics. They're a buy, but they flagged cautionary note on valuation given market enthusiasm around LEAP ramp. So they like the company, but they're worried people are paying too much.
What about the bulls?
Barclays is a big bull. They're calling for 26% operating margins as an inflection point, driven by backlog conversion and the MRO surge. JP Morgan is overweight, and they're focused on the GE9X engine transition and 777X certification.
The GE9X is the really big one, right? That's the engine for the Boeing 777X, which hasn't even delivered yet.
Right. The 777X is expected to deliver in 2027, and when it does, you're looking at a totally new revenue stream that dwarfs what they're making today. That's a multi-year catalyst.
Let me walk through the bull case first. You've got a company that dominates a critical, hard-to-replace industry with 76% market share in narrow-body engines. That's not fragmented, that's a moat.
It's a real moat. FAA and EASA certification takes years and billions of dollars. You can't just spin up a new competitor overnight.
Second, the backlog. $190 billion in committed revenue is extraordinary visibility. That's years of work already spoken for. Third, you're entering the most important structural driver in this company's post-spin history, the LEAP maintenance cycle. When an aircraft engine gets 10,000 flight hours, it's coming off the wing for serious work.
And that's happening to 49,000 LEAP engines starting right now. Some of them are already cycling through. That volume multiplier could drive 30 to 40% more shop visits.
So margins expand, FCF accelerates, and you're still valued at a reasonable multiple relative to growth. That's the bull. Now the bear case.
The bear case is valuation and execution risk. You're paying 44x forward earnings for a company that's historically been a cyclical industrial. That's a stretch multiple.
What kind of multiple would you expect?
Raytheon Technologies, which is also in aerospace and defense, is trading at 39x forward. Rolls-Royce is at 37x. Even Safran, which co-owns CFM with GE, is at 24x forward. So you're paying a premium.
Why the premium?
Because the market believes in the LEAP cycle and the 777X opportunity. But here's the bear risk. If either of those catalysts is delayed, or if the aerospace cycle weakens, that premium gets cut in half really fast.
What about the operational risks?
Supply chain is still a mess. Raw material costs are up over 40%, and manufacturing bottlenecks are real. If GE can't ramp LEAP production to 2,000 units in 2026 as planned, margins compress immediately.
And then there's the 777X itself. That plane doesn't have any FAA certification yet. If there's a delay with that program, the GE9X revenue story gets pushed back.
So you've got execution risk, valuation risk, and geopolitical risk. Trade restrictions or defense budget cuts could slow military orders. Bull case is right, but you're paying peak cycle prices for it.
How does GE stack up against other aerospace players?
Raytheon Technologies is the closest comp, and they're more diversified. Missiles, avionics, electronic systems, all mixed in with Pratt & Whitney engines. RTX trades at 39x forward with 1.36x sales, and they're growing at 12.1%.
So RTX is cheaper on a multiple basis but less focused.
Exactly. The market docks RTX for the Pratt & Whitney GTF ramp challenges they've been dealing with. That's a drag on the narrative.
Rolls-Royce.
Rolls-Royce is the leader in wide-body engines. Think Boeing 777 and Airbus A350. They're at 37.5x forward with a 1.1x sales multiple, growing at about 12.15%. Strong margin expansion momentum, but European regulatory and macro headwinds are weighing on them.
And Safran?
Safran's the 50% partner in CFM LEAP and has a broader propulsion portfolio. They're at 24x forward, growing at 10%, trading at 1.3x sales. That's the cheapest multiple in the group, partly because Safran's more diversified, but also because European macro sentiment is weak.
So GE's trading at a premium to all of them.
To all of them. Whether you think it's justified depends entirely on your conviction in the LEAP maintenance cycle and the 777X program.
What are the options traders telling us?
The put-call ratio is sitting just about 1-to-1, so not heavily skewed to either side. EV is elevated at the 67th percentile, which tells you there's some caution in the market.
Where are the positioning clusters?
On the upside, you've got call open interest clustering around $300, $310, $320, and $330. That's the let it ride higher bet. On the downside, puts are clustering at 280, 270, and 260.
So the market's comfortable with upside to 330 years, but wants downside protection below 280.
That's consistent with the 25% upside target from the street. Traders are buying call spreads for upside exposure, but they're also hedging against a correction back to where the stock was last month.
It's cautious optimism with execution risk awareness.
Insider activity is a mixed read. Over the past 6 months, we've seen 0 insider buys and 10 insider sells.
That's a pretty stark ratio.
Including a February 2026 sale by SVP Riccardo Procacci. Now, that doesn't necessarily mean insiders think the stock is overvalued. A lot of those sales could be routine tax-related dispositions, prearranged selling plans, dividend rebalancing, that kind of thing.
But it's worth noting that we haven't seen any insiders stepping up to buy at these levels. That lack of conviction is interesting when the stock is near all-time highs.
It suggests insiders view the stock as fairly valued, not cheap. That's a data point to keep in mind.
What should people be watching for?
First risk is the supply chain. Raw material costs are up 40% plus, and if GE can't absorb that into margins, operating profit gets squeezed. Second risk is valuation. At 44x forward earnings, you're in discount store territory if the growth narrative slows.
Third,
defense budget uncertainty. If we see a congressional budget fight or geopolitical shifts that reduce military engine orders, that drags the entire company.
and the 77X.
That's the biggest catalyst wildcard. If Boeing's certification gets delayed another year, the GE9X program gets pushed back, and a significant growth pillar gets postponed.
On the flip side, what are the catalysts that could drive shares higher?
LEAP production hitting 2,000 units in 2026, which is 40% growth. MRO surge starting to hit the P&L visibly in Q2 or Q3. And any positive news on 77X certification timeline.
So here's the summary. GE Aerospace is a fortress with an incredible backlog and an installed base that generates recurring revenue for decades. Margins are strong, cash flow is generous, and you're entering a structural cycle of higher maintenance demand.
But you're paying peak cycle multiples to get exposure to that. The stock is up big since the spin-off and valuation has run ahead of fundamentals.
So it's not a screaming buy and not a screaming sell.
Right? It's a good company at a fairly valued price. The execution has to go well, the 777X has to land on time, and the MRO cycle has to materialize as expected.
The key metric to watch is operating margin. If they can get to 26% operating margins by year-end, as Barclays predicts, the valuation compression risk eases and upside to $355 becomes reasonable. Before we wrap, let me leave you with a quote from Larry Culp. He said, "The responsibility of leadership is to provide direction and momentum and to remove the friction from the organization so that great people can do great work."
That's a pretty good philosophy when you've got 57,000 people and a $190 billion backlog.
And that's the thing. Leadership matters. Culp's proven he can execute on this playbook, so the bet here is really on his ability to move the needle on conversion and margins. That's going to do it for episode 82 of Charged Alpha. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.